Hello, and if you're looking to maximize your return on investment, there's no more compelling asset class than leveraged finance or high-yield bonds. The iShares 0 to 5-year high-yield corporate bond ETF, SHYG, is a $5.8 billion fund with an SEC yield of 7.45% and an average maturity of 3 years. That is an attractive profile, so let's take a look at how the market sees the credit risk of the bonds in this fund. First, one feature of the bond market is that for every single maturity, you can earn some yield even when you take no credit risk by investing in a U.S. Treasury bond. That opportunity is not available in the stock market. There's no such thing as a risk-free stock. For every corporate bond, there's a premium above that risk-free U.S. Treasury yield that every investor earns for taking credit risk. Two things we can say about this premium are: 1, for two bonds of the same maturity, investors will demand a higher premium or credit spread over the U.S. Treasury yield for the bond with more credit risk. 2, every additional day before maturity contains some incremental credit risk. Given these facts, there's a short formula that's used by the world's largest financial institutions to manage their risk, and it gives us the survival probability of any corporate bond. A constant recovery rate is used for each payment rank until there's a market consensus to use a different one for a specific issuer, and 97% of high-yield bonds are secured or senior unsecured. Since we essentially have two active ingredients in our formula, credit spread and maturity, let's say we only look at 2-year bonds with different credit spreads in our picture on the left, and only credit spreads of 200 basis points, that's 2% above the equivalent U.S. Treasury, for different maturities on the right. On the left side, we see a 200 basis point spread results in a survival probability of 95.65%, and on the right, a 2-year maturity results in the same survival probability. Makes sense since everything's the same. Now, let's say we have a bond with a 400 basis point credit spread and a 2-year maturity, and that survival probability is 91.49%. Then we look on the right at a 4-year bond with a 200 basis point spread. That survival probability is also the same, 91.49%. Starting with two bonds of identical terms, you can double the credit spread of one, then double the maturity of the other, and get the same survival probability. Let's keep this in mind as we review the SHYG. For the 1,000 bonds in the fund, the weighted average survival probability is 86%, and 1/8 are below 80%, averaging just a 71% survival probability in that group. In fact, here's $110 million of bonds from 10 borrowers with survival probabilities between 40 and 64%. The market does not have high hopes for these. Only a quarter of SHYG bonds are SEC registered issues, which require public filings equivalent to the disclosure for publicly traded stock. Borrowers with only private placements or 144A bonds are not required to disclose any financial information to investors, so the bar for transparency is much lower. Looking at just SEC registered issues in SHYG, we see that a dozen borrowers account for over 1/3 of the bonds. Let's start with these, make a few substitutions to improve our yield and optimize our risk profile. For the riskier names, we'll also select the shortest bond from each borrower, which ensures that we're at the front of the line for redemption payments. This is a luxury stockholders don't have since there's only one common stock for each company. Now, let's open the GoodFill app available in the Apple App Store and look at our borrowers' fundamentals along with some market technicals. Since this is a high-yield portfolio, let's start with a couple of REITs managed by the same company, RMR. On the left is our highest yielding issue, the OPI 4.5% coupon, maturing in February of 2025, less than a year long, yielding over 27% with a survival probability of 81%. We also look at diversified healthcare trusts, 9 3/4 of June 25, yielding 9.44% with a survival probability of 93.7. Let's tap the chart icon in the bond tiles to see the recent price and yield action in the graphs on top. In the graphs below, we can see the daily average trade count over the past 2 months, which indicates key trends and smooths out the data from the regulator FINRA since post-trade revisions are common. The OPI bond has ranged from the high 70s to the 90s over the past 6 months, yielding in the teens percent up to the 30s. They recently prepaid a $350 million bond that was due this May, always a good sign. Their other bonds, including this one, fell in price and rose in yield around the time of those refinancing discussions, which is very common, and prices recovered early this year once that was out of the way. Since the bond price has been steady in the low 80s and it's short dated, the yield and credit spread have drifted up, and as it approaches maturity, any price change will have an increasingly large impact on the yield. Trade count over the past 6 months has been robust, growing from less than 20 per day on average to the high 50s and is currently in the high 40s. This is a consistently actively traded bond. Looking now at DHC, this price action has been more stable over the past 6 months, yielding as much as 12% and recently trading down to the low end of its range, below 9.5%, putting its survival probability above 93%. Daily trade count has mostly been in the 10 to 15 range, indicating decent, stable market interest in the issue. Now for their fundamentals. DHC's leverage was a bit toppy at 12.5 times, while OPI's was reasonable at 8.3. OPI's free cash flow was a healthy $141 million last year, DHC had 10, and OPI had $32 million of free cash last quarter compared to -7 for DHC. In EBITDA, OPI had $312 million last year, DHC's was $225 million, while OPI had $75 million of EBITDA last quarter versus $55 million for DHC. OPI's tangible book value was $1.2 billion and DHC's was $2.3 billion. These companies are survivors. Next up is Medical Properties Trust, MPT, although the ticker is MPW, and Hudson Pacific Properties, both also REITs. MPT's shortest bond is 5.25%, maturing in August of 2026. Hudson's is the 3.95% of November 27, and those yield 9.21 and 7.66, with survival probabilities above 87 and 86% respectively. In price action, MPT has been drifting higher to above 90%, pushing yield lower with a daily trade count above 20 since the beginning of the year. Hudson Pacific's price has been in the high 80s with a trade count above 10 for the past couple of months. On the fundamentals front, MPT and Hudson were levered 9.5 and 10.2 times respectively, not outrageous. Free cash last year was $505 million for MPT, $226 million for Hudson, and those numbers were $135 million at MPT and a small but positive $7 million for Hudson last quarter. MPT had $165 million of EBITDA in the quarter. Hudson had $88. Hudson's full-year EBITDA was $432 million, while MPT had $1 billion of EBITDA last year. For tangible book value, Hudson had $2.4 billion, MPT's was $7.6 billion, and Hudson's market cap is $913 million, while that figure is $2.8 billion for MPT. These are substantial valuations. Shifting now to the Lumen Technologies 5 5/8 of April 25, yielding 11.34%, and the Dish DBS 5 7/8 of this November with a yield of 13.05. Lumen's price has been drifting higher on a trade count in the teens, indicating increasing confidence in the issue and putting its survival probability above 92%. Dish's price has been trending up over the past month, with volume declining from its peak, although still strong at an average of 38 trades a day, and the survival probability over 93%. Looking now at fundamentals, Dish DBS's parent EchoStar was levered 11.5 times, while Lumen's leverage was a very reasonable 4.8. EBITDA last quarter was $1.7 billion for EchoStar, $787 million for Lumen, and their full-year figures were $2.2 billion and $4.2 billion respectively. Lumen's market cap is $1.5 billion, EchoStar's is $3.8 billion. Shareholders believe in these companies, and bondholders get paid before they do. Turning now to food and shopping with the B&G Foods 5 1/4 of September 27 and QVC's secured 4.45 of Feb 25, yielding 7.52 and 7.86% respectively. B&G's survival probability is above 90%, QVC's is over 96%, and both charts show prices drifting higher, yields lower, with volumes declining towards the middle of their ranges. Fundamentally, B&G's leverage was a reasonable 6.4 times, while QVC's parent Curate came in at a very manageable 5.1. B&G's EBITDA last quarter was $90 million, Curate had $326 million, and full-year EBITDA was $330 million for B&G, $1.1 billion at Curate. Free cash flow. B&G had $83 million last quarter, Curate had $236 million. B&G's free cash was $222 million for the full year, while Curate had $576 million of free cash flow last year. Market cap. Curate's is $510 million, while B&G's is $887 million. All healthy levels. Now for the Genesis Energy 8% of Jan 27, yielding 7.6%, and the Icon 6 3/8 of December 2025, yielding 6.84%. That's Icon's second shortest public bond since the September 24 issue yields less than 5.3%. The survival probabilities of these two issues are above 91% and 95%. Prices and yields have been stable, with an average trade count around 10 for Genesis and 25 for Icon. Fundamentally, Genesis was leveraged 5.7 times, while Icon's leverage was a very tame 3.7. Genesis had $147 million of EBITDA last quarter, Icon had $288 million, while EBITDA for the year was $660 million at Genesis and $1.9 billion for Icon. Tangible book. Genesis had $820 million, Icon's was $4.5 billion. Market cap. Genesis $1.3 billion, Icon $7.3 billion. These companies have the confidence of the market. Lastly, in the manufacturing sector, we have Park Ohio's 6 5/8 of April 27, yielding 8.96% with a survival probability north of 86, and Titan International's secured 7% of April 2028, yielding 7.29 for a survival probability above 87%. Prices and yields have been stable and daily trade counts average just above 20. Park Ohio was levered a modest 5.5 times, while Titan International's leverage was just 2.2 times. EBITDA last quarter was $26 million at Park Ohio, $31 million for Titan, with $124 and $192 million of EBITDA last year, respectively. Free cash, $21 million for Park Ohio and $19 million for Titan last quarter, with $25 million and $118 million of free cash, respectively, last year. Park Ohio's market cap is $348 million, while Titan's is over $900 million. Not one red flag. Now let's take a look at our overall portfolio. We've increased our yield by 1.75% from SHYG to over 9.1%, shortened our average maturity by 10 months to 2.1 years, and increased our weighted average survival probability from 86% to over 89%. 92% of our bonds have survival probabilities above 85%, only OPI is below that, and none are below 80%. We do have 4 real estate investment trusts, 2 in offices, and 1 each in medical and healthcare property. Otherwise, we have 1 cable company, 1 wireless company, 1 shopping network, 1 food producer, 2 manufacturers, 1 energy, and 1 portfolio management firm. We've gotten rid of the huge number of deeply distressed issues in SHYG, and coupon payments are a small burden compared to principal redemptions. For that reason, any trouble in our bonds would most likely not occur until a maturity, and for all our borrowers except Icon, we own the earliest public ones, so we only have 1 maturity to clear for each of those names. If we stress test our portfolio just like banks do and say that one of our riskier credits, DHC for instance, falls down ahead of their next bond maturity, trading down to 60% below where $2.5 billion of Silicon Valley Bank bonds trade today, we still earn 7.5% more than the yield of the SHYG. In fact, OPI can also default to the same level along with DHC, and we still earn above 5%. More than the 2-year US Treasury note. Apply your own stress scenarios directly in the GoodFill app, mix and match bonds as you like, and choose any possible default date and recovery level. Our prices and yields are updated every minute so you can monitor your dream portfolio in real time, and whenever you're ready, send it to yourself and upload it with Basket Trader to your Interactive Brokers account. You can buy your whole portfolio with 1 click. The levels you export from GoodFill assume a maximum commission of 0.2% upfront, and you will not pay any more than that at Interactive. Leveraged finance is often mentioned as the asset class with the best risk-return profile, and I wish you great success in your investment journey, starting with GoodFills.